Every banker will tell you the system is sound. Every politician will promise the debt is manageable. And every time, the fine print tells a different story. From Argentina to Greece, from Iceland to Zambia, nations have been brought to their knees. Not by armies, they've woken up to find their sovereignty auctioned off, their public assets sold for pennies on the dollar, and their futures owned by creditors they never met. Crisis isn't an accident. Crisis is a mechanism. The real question isn't whether nations fall into debt. It's who is waiting to collect when they do. The illusion of control is the most seductive lie in modern finance. We look at our governments, our public institutions, and we assume they are sovereign. But sovereignty is not absolute. It is conditional. And the condition is solvency. That's why the history of debt is so revealing and so terrifying. Every default, every bailout, leaves behind a blueprint, a pattern of how real power is transferred, and how tangible wealth is stripped from the many and consolidated by the few. And if you understand this pattern, you'll see that the true masters of the global economy aren't the ones who issue the loans. They are the ones who own what is sold to repay them. First, take the story of a man who remains a ghost in the machine of global finance. He wasn't a household name like the heads of Goldman Sachs or the IMF. He rarely gave interviews, and his photograph was almost impossible to find. He began his career in the quiet, wood-paneled offices of international banking in the 1970s, a world obsessed with a single, glittering prize: sovereign debt. His peers, the brightest minds from the best schools, were all chasing the same thing. They were competing to lend enormous sums of money to developing nations across Latin America, Africa, and Asia. The logic seemed flawless. Countries, unlike corporations or people, couldn't go bankrupt. They couldn't just disappear. They had taxing power, natural resources, and an endless ability to print money. Lending to a country was seen as the safest bet in the world. But this young, reclusive financier saw something else. He watched as his colleagues celebrated massive loan agreements, treating government IOS bonds as if they were pure gold. He attended the lavish dinners where finance ministers would sign away their nation's futures for a quick injection of cash. And in those moments, he had an epiphany that would change the course of his life and, in a quiet way, the world. He realized everyone was focused on the wrong side of the equation. They were all fighting to be the creditor. He saw that the real, unshakable power wasn't in lending money to countries. It was in owning what those countries would be forced to sell when they inevitably could unpay it back. While the world's most powerful banks and financial institutions were busy trading paper, this man focused on a different pattern entirely. He stepped away from the prestigious world of sovereign bonds and began studying something far less glamorous: physical reality. He wasn't interested in interest rates or currency fluctuations. He was interested in ports, in water systems, in power grids, in telecommunication networks, and in mineral rights. He mapped the world not by borders or flags, but by its critical infrastructure, the tangible, irreplaceable assets that made a country function. His strategy was built on a single, brutal certainty: every debt boom is followed by a bust. He knew that the flood of easy money being lent to these nations wasn't for productive investment. It was being siphoned off by corrupt officials, spent on vanity projects, or used simply to service the interest on previous loans. It was a house of cards, and he was patiently waiting for the wind to blow. He built a small, intensely private fund, staffed by a loyal team of geologists, engineers, and political analysts. They didn't build complex financial models to predict market movements. They built dossiers. They profiled countries, identifying their economic choke points: which port handled 80% of the nation's trade, which reservoir supplied water to its capital city, which power plant kept the lights on in its industrial heartland. He wasn't gambling. He was preparing. His peers and the banking world thought he was insane. He was turning his back on the most profitable game in town to buy dusty, boring, physical things. They were trading digital promises worth billions. He was studying blueprints for sewer systems. But he wasn't just buying assets. He was buying the collateral of the entire global financial system. And he was doing it before the pawn shop was even open for business. The moment he was waiting for arrived in August 1982, when Mexico announced it could no longer service its foreign debt, triggering the Latin American debt crisis. Suddenly, the safest bet in the world had defaulted. Panic ripped through Wall Street and the City of London. The same banks that had been desperate to lend money were now desperate to get it back. This is where his genius became terrifyingly clear. The IMF and the World Bank swept in, as they always do, with a rescue package. But the rescue came with conditions, a series of structural adjustments. These weren't just suggestions, they were commands. Devalue your currency, cut public spending, and most importantly, privatize your state-owned assets to raise cash. And just like that, the greatest fire sale in modern history began. Nations, desperate for dollars to pay off the very banks that had gotten them into this mess, were forced to auction off their crown jewels. And who was there, waiting with a checkbook? Not the banks. They were the creditors, demanding payment. They couldn't also be the buyers. It was our reclusive financier, when a South American nation had to sell its national telecommunications company. He was the only bidder with enough liquid capital and nerve to close the deal. He didn't haggle. He didn't negotiate. He simply paid the price, a fraction of its true worth. When an African country was forced to privatize its water and sanitation board to satisfy its European creditors, his fund was there to take it off their hands. He wasn't the lender, banging on the door for his money. He was the quiet gentleman who offered to buy the door, the walls, and the foundation of the house itself. He repeated this pattern again and again, across continents and decades. He built an invisible empire, one that didn't appear on any map. It was an empire of necessity. He owned the pipelines that carried the oil, the transmission lines that carried the electricity, and the fiber optic cables that carried the data. His control wasn't based on debt. A debt can be defaulted on. A loan can be restructured. A creditor can be defied, but you cannot default on the company that owns the port your country needs to import food. You cannot restructure your deal with the entity that controls the water coming out of your citizens' taps. He was no longer a financier. He had become the world's landlord. His power was subtle, but absolute. If a newly elected populist government threatened to raise taxes on his port operations, a quiet call would be made. Suddenly, shipping containers would face unforeseen logistical delays. The flow of goods would slow to a trickle. Store shelves would begin to empty. The economy would start to seize up. The threat of nationalization was met with a simple, unspoken reality. You can seize the asset, but we control the global network it plugs into. We can turn your port into a ghost town overnight. Before long, the new government would fall in line. He achieved something that kings and conquerors only dreamed of. He held leverage over sovereign nations without firing a single shot or casting a single vote. He wasn't a creditor who could be vilified in the press. He was a private sector partner, an infrastructure investor, lauded by the very institutions like the World Bank that had forced the sales in the first place. He had discovered the ultimate form of political and economic control, one that operated beyond the reach of democracy and beyond the consent of the governed. This tale isn't just about one man. It's about a wealth pattern that has come to define the 21st century. The global debt system, we are told, is about providing capital for development and managing economic stability. But its true function is far more primal. It is the most efficient mechanism ever invented for the large-scale transfer of tangible, real-world assets from the public commons to private hands. The cycle is always the same. First, global financial powers encourage and facilitate a massive buildup of debt, both public and private. Second, when the inevitable crisis hits, international institutions impose austerity and demand privatization as the price of a bailout. Third, a select group of private actors, positioned in advance, acquires these critical assets at bargain prices. The public takes on the debt, endures the austerity, and then permanently loses control of its own essential infrastructure. The debt is socialized. The assets are privatized. This is the hidden engine of modern capitalism. It's not about creating wealth. It's about transferring ownership. The man who became the world's landlord didn't invent this system, but he was the one who saw it for what it was. First, He understood that in a world drowning in paper promises, the only thing that matters is owning the physical reality that everyone else takes for granted. He knew that the ultimate power isn't holding the IOUs, it's holding the keys. You think the story ends with him, but here's the part loyal viewers will appreciate. You think this was just a game for the elite.